Well, you give the president of the United States a Twitter account and allow him to escalate and de-escalate through tweet. Perhaps there's a new Greek called tweet gamma, which is you've just got to follow Truth Social. You have to appreciate the uniqueness of this specific risk event. Kevin Warsh once told me, if you've seen one financial crisis, you've seen one financial crisis. There is commonality, but they're all unique. A decade ago, it was Brexit, and we were following British pound vol. Right now, it's crude, and that's the epicenter of every single correlation out there. It drives the VIX, it drives the MOVE index, the S&P, credit spreads, and Trump drives crude.
Speak to Global Wall Street right now, listening across the nation, around the world. Dean Curnutt, we've had a short cover. We've had an OMG, we're going up cover. What is the positioning right now that you see?
Yeah, it's an incredibly important question, and it's very difficult to disentangle what's going on oftentimes because, of course, there is a ceasefire. There is some kind of green shoots of good news. You wouldn't see crude fall by as much as it has unless you'd seen that. And yet markets have got a lot of mechanical trades that live and breathe within them. There's a CTA trading strategy, commodity trading advisors, which essentially got very short on the way down. And then as the ceasefire prospects emerged, they had to rebuy. So that was a lot of fuel adding to the market. If you bought hedges a couple of weeks ago, you bought them at a very high VIX. They were expensive hedges, and they're going to lose value very fast because, as you referenced, Tom, the VIX has fallen fast. It's not just fallen, it's fallen fast. So if you are long these hedges, you've got to get out of the way. If you want to retain any value for that insurance, you got to sell it fast because the market's going up and implied volatility is going down. It's a double whammy against you if you want to keep some value. That also adds fuel to the fire because when you sell a put that you own, someone's got to buy stock. That's the hedge. And again, all of these things have happened all at once. And so what I would just say is I kind of caution the interpretation that, okay, the VIX is way back down, and that means that there's a lot of optimism on the ceasefire. I think there's some, but we've got to respect the positioning that got kind of reorchestrated as a result of the ceasefire as well.
Dean, when you're talking to your clients right now, do you feel like they're looking to buy protection, or are they looking to maybe buy some risk here?
Well, I think it's kind of a both, right? You can't get away from the S&P as a benchmark. We're basically back up. We've really round tripped from
7,000 on the futures. Wow.
Yeah, we're really exactly where we were on the eve of the war. And for folks who are managing capital, the risk of falling behind is a real thing, right? So the S&P is this benchmark that you really have to be careful not to underperform. So yes, they are reweighting. Now, if they're listening to us, they're also looking at the prospects for owning insurance. That's really what the VIX is. It's a proxy for the price, really, of a 5% 1 month put on the S&P, 5% out of the money. And that's going to cost you something like 55 basis points right now. I think that's a really good deal.
I was going to say, is that expensive or not?
It doesn't seem like it's right back to where we were on February 26th. In fact, the day before the war, this put now costs 25% less than it did.
Okay.
I find that hard to square. I think that the last 2 months have added to the totality of uncertainty that investors are up against.
Do traders want to go into the weekend with risk? Because as you mentioned, we're just one social media post away from Armageddon, or just one way or the other, positive or negative. I'm not sure. So what do traders do kind of towards the end of the week?
Yeah, I think, well, so there was a little bit of a trend where the Thursdays and Fridays were bad returns, and then Monday, Tuesday, Wednesdays were good returns. I think we're a little bit away from that right now. And I think what we have to recognize is that there does seem to be a motivation for Trump to try to, kind of tie things up and declare victory. That's the strategy, and I think we have to recognize that.
A real treat for Global Wall Street here at the 7 o'clock hour. We start strong. Dean Curnutt with us, founder, chief executive officer at Macro Risk Advisors. I make jokes about it, but it's all Greek to say that. Let's do a book pause here. So I'm here one day in the Combine. It's sort of like Game of Thrones. It's like in season 3, that big tall tower. That's what Bloomberg's like. Somebody comes up, a minion. There's someone upstairs to meet you, and he's very strange. I go to the escalator and I look up, and I'm almost in tears. It's Sheldon Latenberg who invented the Bible on options. I kid you not. He's got the short sleeve white astronaut shirt, like in Apollo 13, with the 14 pencils in the plastic container. Explain to the kids right now, some of them passed CFA or, announced 2 days ago. Some of them flunked. Explain the value of learning the first 7 Greek letters in finance.
Well, I think I'll quote Annie Dukes, the famous poker player, her book, Thinking in Bets. We all think in bets. We all think in probabilities. And I think that's, if you're trained in the options market, there's a couple things. One is that there's the physics side, the heat equation, and all the fancy math and Greeks that come out of that. That's fun and interesting. And I think it provides you with a framework to think about relative prices, arbitrage type prices. So that's the first thing. The second thing is markets are strange sometimes, and they can get very far away from the physical sciences interpretation of black shoals. You have to be very careful, and you've seen a lot of folks, brilliant folks like long-term capital, blow up with the model being gospel.
So let's go to chapter 14. Nobody reads it. Theta, that's where I live.
Yes.
The DX folks in the calculus. Theta to me is the most understood thing here. Explain if a pro has a bet, the VIX is moved, they have to re-hedge. Explain how they handle the theta, which costs money. That's the biggest problem. Nobody ever says this in the media. It costs money to hedge.
Yes. So the best feature embedded in an option contract is that it gives you the right to change your mind. Wall Street is it doesn't really give out free lunches at all. And so it charges you for the right to change your mind. That's important. And the charge, Tom, is theta, meaning if you own an option contract and you're all jazzed up about hedging and you think the market's going to fall fast, and nothing happens, one day that goes by is the theta. That's the time decay. So all else equal, that option contract is going to be worth less tomorrow than it is today. That's the theta. And what you're balancing that against is the level of churn, the movement in the market, because the movement is what allows you to make money on theta's inverse, which is the gamma, right? That's the rate of change that you can monetize.
Okay.
And that's what you're balancing. It's the time decay versus your ability to make money trading when you own options.
Paul, should we move on?
Please, thank you.
You brought up theta.
Exactly, he did. Tom asked for it. Dean, over the last 6-7 weeks with this war here, how would you characterize the trading in the market? It didn't feel panicky to me. Yes, we had the VIX kind of push out to close to 30, but it didn't feel panicky. What did you see in the marketplace?
Well, if you look at the results from the big banks, the trading was fast and furious.
Yep.
All things considered, this is a fascinating event to study. The VIX, I think, on an intraday basis got as high as 31. It's high, but during the tariff tantrum last year, it got to 55.
Oh, okay.
So that was considerably higher, and the drawdown was considerably greater last year. What you do see in these sort of more macro events, where, again, crude is the epicenter, and the linkages become prominent, is a move towards index and ETF trading, right? So there was much less discussion around the AI trade over the last couple of weeks. That's maybe going to come back into view because earnings are coming. But people were very furiously trading macro instruments, and that's going to lead to options and ETFs.